We are not, while FIIs will affect us because they are 17.5% of the industry, even mutual funds are 8% of the market cap of the country.
People
don't get worried when the markets fall.
Yeah.
In fact, people want to invest when, that is why there is a mutual funds will become a counter force to the FII selling. My this month's salary will go in multi-asset and volatility is good. Volatility makes you money. The power of compounding after investing for 30 years, I can say that the power of compounding is tremendous. Either do your own good research and then invest in stocks.
Hi there and welcome to another edition of the CNBC TV 18 Market Cafe. I'm your host Surabhi Upadhyay. Mutual funds, a lovely little financial product that has revolutionized investing in this country. Now the stock market of India is not run by foreign investors alone. It's run by you and by me, retail Indian investors. Today I'm calling someone on the show who's actually an old friend. He is the CEO of one of the largest asset management companies of the country. Nimesh Shah, head of ICICI Prudential Asset Management Company. I plan to sit Nimesh down and ask him about the trends, the funds to invest in a market like this, and specifically ask him about tips that young investors can keep in mind when they start their investment journey. So let's go. Hi Nimesh, thank you so much for coming over. It's
Always
great
nice
to have
to
you
meet
in the
you.
office.
Yeah.
Not the studio, this is the Market Cafe. Let's have you here. Come,
A very
please.
different setup.
Please take a seat. Nimesh, it's so good to see you. It's been such a long time. I think last we met in Café.
Yeah, you have been very, very
3
busy.
years ago.
Doing various things.
No, you're the busy man because your sector, your industry is the hot industry and sector.
Yeah, that we won't have complaints about. The industry is doing very well. The industry, I think, has done very well for the investor. And the way SEBI regulations have come across is that whoever does well for the investor will get in further money.
Yeah.
So 88% of what is the new sales for ICICI Prudential actually comes from existing customers only.
So
Right?
repeat
So
customers.
Repeat customer is the theme. Repeat customer, the old customer is happy, he is giving you more money. So the industry is going on growing.
But tell me, specifically this year, the last 12 months, so much has been thrown at the mutual fund industry, right? There was a change in taxation on the debt side. That was the big headline. Then there was this talk about the way mutual fund industry makes profits, the TER expense ratio issue is there. Now there is talk of a whole new category called high risk funds. In between there was this whole influencer drama that you guys can't associate with influencers unless they're registered. A lot to take in this year, no?
See, I've been watching this industry since 2007. I have been doing this job since 2007. And my take is that every year the regulator has made it more and more pure for the investor. Why is this industry doing well? This industry is doing well because of the good regulations in the industry, we have consistently delivered for the final customer. The final customer is happy. It gives me a lot of happiness today to say that 99% of the customers who have stayed with me for 3 years, right, who have completed 3 years with me, have earned double-digit returns, right? So that's what we look forward to. That gives us happiness. And if we are kept our customers happy, we will get and will keep on growing. And anywhere in the world, it has been seen that we were 10% of the banking industry 10 years back. Today, we are 24% of the banking industry.
So many
Right?
investors coming
In 10 years, we have moved from 10% of the banking industry AUM-wise to 24% of the banking industry. So any country in the world, when the per capita crosses $2,000, the AMC industry will keep on growing. So I envisage by 2030, we could be 1/3 of the banking industry.
Wow.
That's the size of this industry.
That's the growth. No, and all credit to you, to investors, because I've seen the change. Earlier, when we used to track stock markets, the day there was a big FII sell number, there used to be panic, like, oh my God, FIIs have sold so much Indian stock. This whole last year, foreign investors have been selling and you folks have been buying, domestic institutions.
So this happened in 21-22 and it was a great, this one that every month FIIs would have for 8-9 months, they kept on selling $5 billion into the market, right? And mutual funds, today mutual funds have got a SIP of 16,000 crores.
Yeah, monthly, drawing in 16,000
So
crores.
plus they are one-time sales. So more or less, we are not, while FIIs will affect us because they are 17.5% of the industry, even mutual funds are 8% of the market cap of the country. So mutual funds are that much of a counter force today to the FII selling.
Good stuff. You know, so viewers, yes, we are going to talk about how young people should invest. That's one of the main reasons we have Nimesh with us on the show. But you have to allow the journalist in me to get to the hot stuff, the masala as well, right? And this is a recent development. Just last week, there was some chatter about regulator, SEBI, maybe, you know, looking at the option of starting a new high-risk category. Your thoughts on this? Is there a need to allow mutual funds to take more risk, or is it just a wrong concept to begin with?
See, when there is a whole risk management, or mutual fund is all about diversification, all about risk management. So when we look at a customer, we look at a retired school teacher in Guwahati, right? If a retired school teacher in Guwahati is investing with me and he remains with me over a business cycle over 5 years, he should have a reasonable experience. That is our lookout, the way we run risk in a mutual fund. So it's quite, mutual fund is a very good platform. And in that platform, we have created various funds, but the risk is very well managed and controlled, right? Risk management. I run ICICI Prudential Risk Management Company. That's what I say, right? My main function is risk management and diversification. Maybe I don't know what is envisaged, but there can be various kinds of funds as long as we transparently disclose and we allow only a specific type of customers to come in. We are balancing. So I don't know what is envisaged, but we should, any part of the business we do, whether we do mutual fund, we do alternates, we have to have the risk management right for the final customer.
You mentioned that you've been in this business since 2007, right? And you've been
I joined
with
ICICI
Prudential.
I joined ICICI Prudential in 2007.
Fantastic. So you tell me, you have seen business cycles, you've seen market cycles, you've also seen investors evolve. What are the bigger changes that you've seen in the last 15 years in terms of investing behavior of the janta which is putting their money in mutual funds?
So very positive. To a certain extent, earlier when I joined the industry, money used to go out in less than a year. There was a huge amount of churn in mutual fund. Today, the average persistency is more than 3 to 4 years, right? So the persistency has increased quite well. So that is one of, and when outflows when markets correct, you normally get inflows, right? World has changed.
That is a huge change, right? That's a huge change. People
don't get worried when the markets fall. In fact, people want to invest that is why there is mutual funds will become a counterforce to the FII selling. I remember 2011, 12, 13, 14, whenever FIIs would come in, markets would go up, and whenever FIIs would 11, they came in 12. So alternate years, market used to go up and down.
Depending on their exit and entry.
So now that is not happening. So that is a huge change. So good if we are able to convince the retail customer that this is a long-term instrument. You make money over a business cycle, and more people are understanding that. But the campaign is still on. It's a long journey where we have to still people look at past returns and come in. Though we keep on saying that past return is no indicator of future performance. Sure. But this has to move.
But your industry is also getting very competitive, right? So many new players are coming in, newer fund houses. Then big international fund houses are all set to, make a splash, make an entry here. What do you think?
We are in a very great country called India, where the market is infinite. We have got less than 4 crore customers with mutual funds. Already what Khelo India Khelo that is happening on the everybody wants to get into stock markets.
India Khelo.
I call it Khelo India Khelo because there are 8 crore people who have got demat accounts. So I see it as a very, very, very exciting opportunity, and I feel more players should come in. They will only grow the market, right? A lot of new digital players who have come in will only grow the market. So I'm very excited with the new players coming in. We will, I think the market will keep on growing. In India, we are in an infinite market. So we should not worry about new people coming in. It is a great opportunity that new guys will come with new innovation, new thinking. So it's good for us also.
Okay. I'm going to ask you about the funds that you like in a bit. I always do that. Whenever I meet Nimesh, I ask him where he would put his money and the funds that he likes. But wait for that. That will come up in a bit. Since we spoke about newer categories and higher risk, right? I think one trend that's very real is also that the mutual fund investor is now willing to take risk. The kind of inflows, for instance, that mid-cap and small-cap funds were drawing in, I think just up till the last month's figures, right? What do you make of that? And is that a challenge when so much money is being thrown at small-cap, mid-cap funds, not so much on large caps?
So that is the problem that people still look at past returns. Since mid-cap, small-caps, 3-year return is fantastic. It is in the 20s to be conservative. Even we give out conservative numbers. So since the past return looks very good in mid-cap, small-cap, people are coming in mid cap, small cap as if there is no this
That
one.
will
So I
keep
would-
continuing for infinity.
nothing continues till infinity. So one is worried.
Yeah.
One is worried about the more rather than the FII selling. We are not talking about the leverage that exists in the country.
Tell us more about this.
The open interest position in stock futures is 2,60,000 crores. It was less than 1 lakh crores in 2020. The open interest in stock call options is more than 1,50,000 crores, which was negligible 4 years back. In 2019, it was less than 10,000 crores.
But this is not just retail investors taking leverage. This is general institutional
a big
leverage,
percentage
right?
of that. Unfortunately, a big percentage that of retail investors.
Okay.
I don't know how many of those retail investors understand the risk that they are running. How many understand that there's a leverage position on the market and corrections can really seriously erode the wealth.
Yeah.
And when SEBI study itself says that 89% of those investors are not making money.
No one's listening.
So no, like it will happen. We have seen this cycle since last 30 years.
Yeah.
It will ultimately, when they lose money, they'll get out of the market.
Yeah.
So we should ensure that CNBC should ensure that more and more knowledge is given, that 89% of the people lose money in all this.
No, we absolutely, and we are seeing that we cover that. SEBI from time to time is coming down with orders, etc., or pulling up certain individuals for promising super high superlative returns, and that's been happening. True. Now, let me ask you about, again, to get back to the point of a regular mutual fund investor looking for higher returns and therefore willing to take higher risks. Explain to us the concept of portfolio management services, because now a lot of mutual fund houses have this whole concept of PMS within the mutual fund entity. You do too at ICICI Prudential MF, right? So explain how this is.
Within the asset management industry, within the asset management industry, I have got one business which is called a mutual fund business. Where I am very clear, risk management has to be much more conservative because the customer can be an ordinary retail customer. So what we can do, there is another instrument called as alternative investment funds or PMS.
Thank you. There you go. There's your coffee.
Where the ticket size, are slightly higher, right? The minimum ticket size that you come in for a PMS is 50 lakh rupees.
Yes, correct.
Right? So the customer is clearly told that when he comes in a PMS or an AIF, we will take the same risk management framework, which is applicable to mutual fund. The same team is there, but when they look at alternatives, they will try and see that maybe the risk is slightly higher. The concentration risk that we allow in a AIF or a PMS is slightly higher than what is allowed in the mutual fund.
Correct.
So what do we have? We have got a central research team which is doing, we have shortlisted 500 stocks in ICICI Prudential, 496 stocks in ICICI Prudential, which we research.
Right.
Now that research is available to the mutual fund side also. That research is available to the PMS alternative side also. They can take more risk and create portfolios for people who want to take more risk or more concentration risk.
Sure.
I think there is a risk return which is clearly explained to the customer.
The question that I want to understand, the answer that I want to get to is whether, as you've seen this business mature, and I'm guessing 3-4 years, right? Whether indeed it is generating the kind of higher returns for which obviously this business takes higher risks. I mean, are you satisfied in general with the way PMSs are performing? Not just yours, but are PMSs fulfilling their objective?
At ICICI Prudential AMC, our AIFs and PMS have fulfilled the objective. I'll just show you one particular slide, which is very interesting in this context. That we have gone and invested in B2B businesses 3 years back. We started, now we have got 3 years track record, or overall we have got a 20 years plus track record with the current team. We had given, in 2018 January, we had returned the money, PMS AIF money, PMS money we had returned to the investors saying that the markets are very high and you have made a fantastic return, take back your money. That's what we did in 2009. Since then, we have built up the business and it has given a fantastic performance to the final investor. We have invested in companies which are growing, which are throwing a nice amount of ROE, and still when you are getting into these companies today, you are going in at a lower PE ratios, right? The portfolio's PE ratio is still lower. So I am going and investing in stocks which the market has not taken a fancy to still now, right? Though they are growing and they were improving ROEs every day. So till now the growth has happened because of growth in EPS, right? Someday market will also recognize that these companies are giving consistent returns. Fund managers who have not invested in B2 companies since last 15 years will also start investing in those companies. And you will see the further growth of this kind of companies.
We've seen that. I think capital goods, the way the sector came back, engineering capital goods, and we've seen some of this revival. Okay, now let me get down to brass tacks, because this is about making investing a little simpler for people who are watching the show. You tell us, looking at the market situation today, if someone is to put fresh money to work towards either a mutual fund or a PMS, what are the things they should keep in mind? How should they start? Should they stagger? Given today's context of geopolitics, rates, etc., and whatever's happening around us.
So without going into too much gyan on where the market is and what are the valuation levels of the market in, so there are opportunities always in the market. But right now, the way we are neither a very expensive market nor a very cheap market. I won't say that the markets are sitting on a bargain and the stocks are very cheap. It is difficult to get cheap stocks today, right? The way I invest every month, right? Whenever my salary comes, a big percentage of that goes into investment. So what do I do? If the markets are very fairly or low, slightly lower valued, then I will take a equity fund. But right now, the way the market is and the way taxation has changed for debt, the only way to get debt tax-free is by investing in the dynamic asset allocation category, the balance advantage category or the multi-asset category. There are two categories of SEBI. That is the balance advantage category and the multi-asset category, where if you invest in debt, since more than 65% is in equity, you will get debt also tax advantage. Right? You are not taxed the way debt funds are taxed.
The taxation is equity taxation for these two categories.
It's very good for the final investor. So in markets like this, when there is no clear-cut sign, I would go and invest in a category called as multi-asset, which is slightly more aggressive than balance. 65% to 70% is invested in equities, and the balance is invested in debt and gold.
Okay, so you have exposure to all three asset classes. That is something that you'd sort of suggest. And that's advice to an overall investor across ages.
This month's salary will go in multi-asset.
Multi-asset funds, and now that explains why there is a plethora of these funds. Almost all AMCs are launching. If they hadn't had this category, everybody's launling the multi-asset category. We have been having
this category since 2004. It was called ICICI Prudential Dynamic Fund once upon a time. It was one of our favorite funds, which was dynamically investing in equity and debt. And from there, we discovered this balance advantage category. It was the original category was this multi-asset category.
Got it.
We have always believed in that because Indian markets will be volatile and volatility is good. Volatility makes you money. So because the Indian customer will be pro-cyclical, we have created these products which are counter-cyclical. Right? I am very proud to say that ICICI Prudential has practically created both these categories.
Balanced advantage and the multi-asset.
And this is since 2004, that when markets go up, you reduce your equity exposure. When markets go down, you increase your equity exposure. So balance advantage fund is much more conservative. The equity exposure would be around 40% or even lesser. And multi-asset fund, it would be around 65 to 70%.
So I know never to look at past returns when you're making your investment decisions, but for just the sake of reference, average returns over a long period, let's say 5 years, 10 years, what is the average return that these two products have given, and what is a reasonable expectation to have when you're getting into either multi-asset or balanced advantage?
So we have had a fantastic run, and I will give you a slide for that also. Or you can look at the data and create a slide for that. It is so satisfying to see balance advantage fund today after 10 years. And I remember I had a talk with you even 10 years back.
Yes, I remember.
So in 10 years, we would have almost given 90% of the Nifty returns while taking only 50% of the risk. 90% of the Nifty returns by taking only 52% of equity exposure. That is a very satisfying line to give. So the risk-adjusted return that a balance advantage fund has given over 10 years is so nice for the final investor, what he was looking for. Even multi-asset fund, frankly, people look at an equity return in multi-asset fund and it is embarrassingly good because it is very satisfying after so many years, after 19 years of performance of a multi-asset fund. It has given very good, it has given equity returns and much better than Nifty returns to the final customer.
Okay, so let me ask you this. If a seasoned investor, a mid-age seasoned investor has a corpus, these are two categories that you've given examples of. They can
looking at the levels of the market.
Looking at the levels of the market. Now this investor today has the money to meet the PMS threshold of 50 lakhs, let's say, or maybe the lower threshold for this high risk category whenever it comes. What should one consider? Because I think that's the dilemma that a lot of people in mass affluent, that upper edge of the middle class, that's what they're facing. That should I cross over to PMS, or am I just okay with my SIP or my mutual fund or my multi-asset fund?
Mutual fund is a great platform. right? Taxation wise, it is too simple, and one should continue investing in mutual fund. But for part of your portfolio where you want to be slightly more aggressive, where you are okay to take concentrated risk, any asset management company with good risk management practices. Like, I'm not advertising, but ICICI Prudential will come with its own risk management practices, which we have been following for our mutual fund. Slightly different, but the same risk management team will look at it. It's very important to look at the brand that you are giving the money to, right? It is all about people. Our business is all about people and the brand and the experience that we have given to the customers over a period of time.
Got it. So I think that's food for thought. People need to do their research and homework before they decide. Now let's come to the central issue. You know, we wanted you, with your experience, to give advice to our younger audiences, young people who might be watching this on YouTube, on our digital platforms. What should one do? How do they start early? Or how can, I don't know, I started with my first investment was an SIP with my salary check, I remember. So is it still the same? What would you say?
Yeah, younger generation is way smarter. They have started investing much earlier. But only thing is they are investing in too riskier products. Again, I'm talking about the options and futures in the market, the levels at that, and a lot of younger people have digitized and gamified the whole thing. But first principle of investing that you should not lose money. And second one is you should not forget the first principle, right? So I would be asking the younger generation to be more careful while investing. It's hard-earned money, and one should not. And the power of compounding, after investing for 30 years, I can say that the power of compounding is tremendous. Either do your own good research and then invest in stocks. Just because somebody has told you, it does not work. We have seen the market since 92, 93. And I have been consistently saying that people who go on somebody else's knowledge and go into direct stocks may or may not work out. If you have got good research capability, or you know some sectors well, and you know those companies well, if you're able to identify good businesses, then go and invest in stocks directly. Otherwise, try and track some good fund managers where you would like to, where you can trust your money. I am saying this business is of trust, and there is something beyond numbers, that where you will trust your hard-earned money for the next 5 years, take a judgment on people, and then give to the money to the right people, and then enjoy your life, rather than worrying about this. Last 1 year, a lot of people will start believing that they are good into markets, right? Because a lot of small caps or mid caps that they have picked up have grown many times. Don't get swayed that you are a good stock picker. Ask yourself, because you create this hypothesis based on what has happened, that you start believing. It is not that you are lying. You start believing because you have got a four-bagger, that you have got some knack that you are able to identify. Ask yourself whether it was good research or it was luck.
It was luck.
And if it was luck, then ride your luck. You've written it well, but then do some good research and invest.
Keep yourself rooted in reality, I guess. That's
it's very difficult. To be rational in irrational times is the most difficult thing in investing.
Oh, got that. Interesting. Lots to think about over there. Okay, now if you were to give me an investment tip, what would it be?
ICICI Prudential Mutual Fund. All our funds do well for investors. They have done well for the investors.
You love your job, you love your company. It's so evident. No, but on a serious note, I mean, any other advice that you'd want to give out there?
No, so it's simple. It's our hard-earned money. We should not lose that money. And markets are volatile. So embrace volatility. Be very comfortable in volatility. And depending on, in India is a great story. Nothing is changing in that. So 5 years, 7 years, invest with ICICI Prudential. We'll manage your money carefully, and we'll do good risk management on your money.
Fantastic. Sounds good. Thank you so much, Nimesh.
Thank you, as usual.
And season's greetings to you. I really look forward to more conversations like this one. Thank you.